Hello, everybody. So today I want to talk about two of my stocks that have reported their earnings this week. These stocks are Crowdstrike and Sea Limited. So let me get started with Crowdstrike. Very happy with the results from Crowdstrike. Crowdstrike for me is a top 7 position, actually. It's a big position, more than 5% of the portfolio, and especially as it is up more than 15% today. Crowdstrike is one of these companies that has had outstanding long-term annual shareholder returns, and that keeps surprising to the upside. These are a few excerpts from their presentation, from their latest investor presentation, which they dropped yesterday. Of course, they see by 2028, they see their market size, the revenue pool to be 225 billion. So they're obviously nowhere near that as far as their ARR goes. They are not even at 2% of the total market size that they estimate the size that it's going to be in 2028. Another good thing about Crowdstrike is that they are the best at what they do, and they show this. They don't just say they're the best. I mean, most companies say they're the best, but they actually show us that they're the best by being ranked the best by the number one IT consultant, which is Gartner, the number one IT consultant. And you can see their product is the leader, better than Microsoft, better than Sentinel-1. It's both the leader in ability to execute and in completeness. And as they said on the call, if you listen to the call, they talk about Palo Alto Networks and about how Palo Alto is trying to get people to adopt their suite of products through discount and giving a bunch of discount. And Crowdstrike does not give discounts. The CEO had an outstanding call, and he keeps saying how Crowdstrike is the best product, and the difference between the best product and the second best product is not acceptable for most companies. Most companies need to have the very best product, not the second best. The second best is not enough when it comes to cybersecurity, which is why they are seeing tremendous demand in many, many sectors. In their CM division, they saw 160% growth year over year. Their identity division, 100% growth year over year. Their cloud division, 90% growth year over year. And their endpoint division is growing at about 30%. That's still the bulk of the business, is the endpoint division, still growing at about 30% year over year. When you listen to the call, you get a sense that Crowdstrike is becoming a much more holistic company with a lot of services beyond just endpoint security. They got started with endpoint security, but they are moving across different categories of IT in general, of cybersecurity, but even IT in general. And so this may become a bigger company than just cybersecurity, which is what they discuss in the call. And they may move into many other aspects of IT. And so this company keeps surprising to the upside. The growth is outstanding, right? With the ARR, ending ARR in Q3 of 2024, as they call it, they are on a forward basis. So actually, when you read 24, you should read 23 in 4Q 23 for them. That would be $2.43 billion in ARR, in recurring revenue. Now remember, the revenue is actually a little higher, always 3 to 4% higher. The revenue is for Crowdstrike, because they still have a few professional services. So you can see that's a gray thing here. But professional services revenue is not recurring. They are really just focusing on that recurring revenue number. That's what they care about. Their subscription revenue is up, ARR is up, the guidance is up too, outstanding guidance at 3.9-ish, let's go at 3.95 billion for the full year 2024, which they call 2025 for them. And if you look at their profit numbers, right, they are outstanding. Now, they communicate on the free cash flow margin, so that's what I'm going to use in my analysis, but that's a 33%. If you see it right here, 33% free cash flow margin. They advertise that they are achieving the rule of 66, which is pretty high, right? Rule of 40 is considered good. And when I calculate their valuation, you can see that the enterprise value after the jump of today is 81 billion. The revenue is 3,056 million. Revenue growth, based on what they've guided here, that will be 31% revenue growth next 12 months that they guided. The gross margin is 80%. So you get an expensive stock on an EV or a sales basis for sure. And you also get an expensive stock on my EV over gross profit over revenue growth metric. And that's mostly due to the fact that price to sales is kind of outrageous. It's a very expensive company. But there's companies that don't grow as fast and that end up looking more expensive in my spreadsheet. And valuation is I don't like to own an expensive company. I'd rather own a cheap company. But companies can stay very expensive for a very long time, right? A company can stay overvalued for 15 years. And so it's important, in my view, to not avoid a leader just because it is expensive. Because if a market wants to grant a very high valuation to a stock, well, that's just the way it is. I mean, this is the hottest sector in the hottest field, right? This is SaaS, and then within SaaS, the hottest field within SaaS is cybersecurity. There's nothing, there's nothing more in demand than this type of company, and so like I said, it's expensive right now. The stock is trading roughly at 24 times sales, 80 times free cash flow. Like I said, it's very tempting even sometimes to sell it, but I don't want to do that. I don't want to do it because I'm up over 150% on the stock. I don't want to sell, and I don't want to pay capital gains tax, and investing to me is a long-run endeavor. A stock can remain overvalued for decades, like I said, and I'll conclude Crowdstrike with this. This is 6 months ago. 6 months ago, they gave us, 6 years out guidance. 6 months ago, they guided for 10 billion in ARR within the next, what right now should be about 5 years, given how good their results are. So in 5 years from now, if they have at least 10 billion in ARR, that means that the stock, if the stock does not move, you'd be at a 8x 2028. And about a 25 PE in 2028. So over the long run, even if there is some change in the ratio, over the long run, I believe there is protection to the downside in this stock over a very long run, right? Over a 5 to 7 year period. Over the short run, who knows where the ratio can go, but I'm a long-term investor and I want to own this company until 2028, 2029. And see what they guide then, and see if they keep that rate of growth. And I'll conclude with this on Crowdstrike. If you look at Crowdstrike since their IPO, their annual return, the average total return, that was 64%. That's verified there. There's very few companies that have been able to compound at 64% annual rate of return annually. This is more than twice my 30% that I look for. So obviously, the market wants to grant a premium valuation to the stock because look at its performance. It's been one of the absolute best performers of the last 11, 12 years. And the stock is not done. And if you had put 10,000 in 2012, you would have 2.9 million today. Sounds ridiculous, but it is a very, very high performing stock, and I'm very happy to own it. And sure enough, people who have owned it for many more years than I have it as their first position, and this company is slowly creeping up as a top position for me, and I haven't had to do anything. I haven't had to add anything to it. So Crowdstrike is expensive, but it can remain expensive for another 10 years. Who knows? Who knows how long this stock will remain expensive? What's important is the growth, and the growth is explosive, and the growth keeps being outstanding. So moving on to Sea Limited. Sea Limited stands for Southeast Asia Limited. They are a company that does three things. They do e-commerce, they do digital financial services, right? Their fintech division, and they do gaming, their gaming division. So of course, this company has the growth has kind of stalled because they were trying to achieve profitability all of last year. The company kind of caved to the market, caved to Wall Street, requesting profitability, and now that they've achieved profitability, they want to return back to growth. I personally think that wasn't a good strategy. I think they should have kept growing regardless of profitability. But that's, there's very few investors who think like that, and Wall Street, of course, was scared in 2022. So that's what they wanted, and because of that, they've had issues, like, for example, a shrinking gaming division. Well, that was partially due to their game being banned in India. But that ban, it looks like, is going away in the future, and they didn't really say on the call when that game will return to India. But they did say on the call that they see the gaming division growing in the mid-teens for 2024, in the mid-teens. So what that means is that, perhaps you're going to see a pickup in India. The gaming division, you're also seeing the bookings being up for the second quarter in a row. They have bookings that are up for gaming. So mid-teens is pretty good. And the analysts right now, they haven't updated their analysis, I think, because if I go on Seeking Alpha and I look at the predicted 12 months growth, revenue growth over the next 12 months is only 11%. But in my view, the way I look at it is I think they're going to achieve closer to a 20% revenue growth, because first of all, e-commerce grew 23% year over year between 22 and 23, Q4 to Q4. That has inertia, right? That you don't go from 23% to 5%, right? So typically, you see some inertia in that business, and so I think it's highly possible, especially as they reinvest in that growth, that we see a similar number, or maybe 21% or something like that, because the business has inertia. Same for financial services; they grew 24%. I think it's likely we'll see a 22 or 21%. Because, again, businesses have inertia, and they are investing in both of these sectors, so they actually could grow faster, because they've said, now that we've achieved profitability, we'll keep achieving profitability, but we're going to reinvest in the growth of the business. And then they guided that the gaming division, they will see it pick it back up at plus 15%. And gaming, because it's dropped so much, gaming division is I think it's going to be likely smaller even than the digital financial services division within a year. So if I do an average weighting of each of these growth rates, and I think I get roughly to 20%, maybe 19 to 20% is kind of what I'm expecting here, and this is mostly due to the fact that gaming is coming back. And so when I take these numbers and I input 20% in my spreadsheet, the gross margin was 45%, you get an enterprise value over gross profit over revenue growth of a 0.27. So that is top tier, cheapest in my spreadsheet, right? When I analyze all of my stocks, my 40 stocks, it is in the top 30% cheapest companies. So inexpensive. EBITDA margin at 9% is what I calculated at, so not very good yet, but they're not optimized just yet for earnings, as they've said they will invest in the growth, and they'll keep investing in that growth. So 20% plus 9%, that gives us a rule of 29%. So just under, just under what I look for on that. But that's because the business is still in a high growth phase. That's an inexpensive company, and I'll conclude with this, for the shortest amount of time, if you go back to 2021, this was one of the best performing stock in all of Wall Street. And despite that precipitous drop, they dropped something like 90% in almost no time. Despite that, if you go back to the date of the IPO of Sea Limited, you're still at 27%. Average annual total return, you're still at 27%. So you're almost at 30% despite that major drop. So this in the past has been a high performing company. It's been a very, very good company. And, if they just return back to their long-term trajectory, you could draw a line on that chart and draw a line right in the middle. I wouldn't be surprised to see this company trend back towards 30-ish% return year after year after year, and that's why I'm happy to own it, because they've been able to do wonderful things in Indonesia. Shopee is the leader in Indonesia. They're doing okay in Brazil as well, which seems to be the one foreign market outside of Southeast Asia that they've kept. The gaming division is coming back. Free Fire is doing a lot of localized content, and there's this, the popularity of their video game is coming back up, and they have very high margins on Free Fire. It's just not them importing the games from Tencent anymore. So lots of good things going for this company. They're investing in their warehouses. So lots of good things. Again, if you're interested, listen to the earnings call. You learn a lot from the earnings call. I've learned a lot from both of these earnings calls, whether it is Crowdstrike or Sea Limited today. And I'm happy to own both of these stocks. I'm happy to own, and I'm not adding to any of these stocks right now. So this was not investment advice. This is just entertainment. I hope you were entertained. I appreciate your likes. I appreciate your subscribes. Thank you so much for watching, and have a wonderful day.